Investing can be very hard and confusing at times to the point you end up making mistakes which are part of the investing process. But when they cost you a lot of money, it can be very upsetting and very discouraging. So as an investor, that's why I need to find out what are those mistakes and how to avoid them in the future. And you, by doing that, are actually on the right path of becoming a very successful investor. So in this video, I'm going to be talking about the top 5 mistakes each and every investor make and how to avoid them. And please be sure to stick to the end of the video for a bonus tip. Number 1, buying companies you know and like. Investors are naturally drawn to buying stocks of companies they know. They buy these stocks because they feel like they know the company, or secondly because they own a product of that company. So they buy because of that mentality that they know the stocks and the stocks are doing it because they own a product of that stock. And it leads to buying companies such as your Apple, your Facebook, your Tesla, your Google, your Facebook, and all the other companies which are well known. However, there's a lot of stocks, over 5,000 stocks in the stock market that can actually make you tons of money. And because you only decided only in investing in the stocks that you know and like, that is actually killing your portfolio more than you can actually realize, because now you're actually missing out on big profits because you as an investor, you only decided only in investing in the stocks that you know and like and own products of. So for example, let's say an investor owns an iPhone or any Apple products and loves using those Apple products. An investor may go now and decide that, hey, because I love these products, let me just go and buy Apple stocks. And just because the Apple just released a new iPhone 14 doesn't mean that the Apple stocks are actually doing well. And it's actually quite the opposite. So the bottom line is, try questioning it whether is this a great company rather than is this a great product. And also don't confuse great products with great stocks, because these are two different things. And also try to broaden your horizons to companies which you are not familiar with and try to learn about them so that you can cash in those big profits. Number 2, chasing trends and following advices from social media. Whether it's the fear of missing out on the current hot stock like Tula Resources, or the fear of missing out on investing on the new cryptocurrency, or you just saw someone on social media posting their easy equities portfolio on social media, whether it's on Twitter or whether it's on Facebook. Chasing trends is a very common mistake which each and every investor makes. So a quick way to avoid this mistake is to always do research of the stock of the company that is being influenced to you before you buy the stock, because you don't know what are the fundamentals of the stock or when that person bought the stocks. And the other thing is also not to take advices from people that don't know your financial situation, and also don't compare yourself to other people, because for example, that person may have bought maybe Tula Resources stocks while they were still trading at 21 rands, and you want to buy them now that they're trading at 300 rands. So don't buy something you don't know just because you saw someone posting on social media all of the profits of that company, and now you have a fear of missing out and you want to buy the stocks because now everyone is catching on profits and you're not catching out on profits. So make sure that you always do research on a company before you buy it, and also don't get easy influenced on social media by people that post all of their profits, because you don't know how they started and what they were doing. Number 3, investing money you will soon need. There's nothing sad and depressing like hearing someone say, oh, I sold these stocks because I had an emergency and I wish I didn't sell these stocks sooner, and I wish I had just waited a little bit longer so that I could have cashed in the dividends and the profit of the company. So we've all heard of that story, and I personally also have that story of my own. But the main point is that I'm trying to get across is that people are jumping into the stock market without building themselves a strong financial foundation, and that is one of the biggest mistakes that investors make. So one way to avoid is that before investing, you should always feel in control of how you spend your money, and a big part of that is always creating a cash reserve, or what we call an emergency fund account, so that you don't always rely on investments every time you have an emergency or you want to purchase something. And a good way for you to know that you're ready to start investing is to actually know and feel comfortable that you actually have money set aside. You actually have a lot of money set aside into your investment account or into an emergency fund account for your near-term goals. And also experts suggest that money needed within a relatively short period of time, like 3 years, that's the money that you should actually put into your investment portfolio. So if you have money that you're actually going to need in a relatively short period of time, like 3 years, then don't invest that money into the stocks, because that's actually going to create a lot of disturbance into your investment portfolio. So before you start investing into any stocks, into any investments, please be sure to build yourself financially, build a secure foundation financially, so that you don't treat your investment portfolio like a savings account. Number 4, looking at your investment portfolio too much. Actively checking your investment portfolio either on the EasyEquities app or any other investment platform can be very addictive and can cause a lot of damage on your investment portfolio than you think. Don't get me wrong, I highly believe in active investing, like rebalancing your investment portfolio when needed to, reinvesting your dividends when you have to, and also always checking whether is everything okay. But this mistake of always checking your investment portfolio is a very common mistake which each and every investor make. So what this does, that money is somehow linked to us in an emotional way. So by always actively checking your investment portfolio, that is actually fueling up your emotion emotional side of the brain. So what that does, that every time there's a win in your stock portfolio, you're always going to be excited, and you're always going to be depressed every time there's a loss in your stock. So what that also does, that can actually end up making an investor make irrational decisions, like always selling their stocks because now the stocks are not doing well at that certain moment. Then also leads them to actually doubting their investment strategy because now the stocks are not doing well and now they want to sell the stocks. So by not actively always checking your investment portfolio, that's a very good thing to always do as an investor, because that allows you to actually make sure that your strategy is very effective to that point, and then you can always change everything that you have to change. But actively changing your portfolio is actually doing a lot of damage because you end up selling the stocks which are good in your portfolio, and another thing is that you actually end up doubting your investment strategy. So a good way to actually avoid this is actually maybe try limiting the time you actually check your investment portfolio. For example, you maybe want to just checking your investment portfolio maybe on a Monday, or maybe you just check your investment portfolio maybe on a Monday to a Friday and not in the middle of the week, or maybe you want to check it on the start of the month, in the middle of the month, and then at the end of the month. Because what this does, that it makes sure that it actually also helps you to show how effective your investment strategy is, because you cannot always be checking how investment strategy is, because you never know how well it's going to work if you don't leave it for a long period of time to actually take its effect. So remember, investing is like a marathon, and you would never see how good you are if you're always checking your time every 10 seconds. But if you're always checking your time after every 1 kilometer which you have completed, that can actually show you how much you are doing and how well you're doing, and whether is there anything that you have to fix. Because if you're always checking your portfolio each and every 10 seconds or each and every day, that will not actually show how effective your strategy is and whether and how do you actually have to fix it. So be sure, guys, to always stay away from the equities account. I know it's very addictive to always check your money because we are linked to the money in an emotional way. So by always limiting your time and always like checking it maybe every after 1 week, that can actually tell you how effective your investment strategy is and how you can actually fix it. Number 5, holding losers for too long and selling winners too soon. Have you ever bought stocks for 2 rand and later sold them for 10 rand thinking that you've made maximum profit, only for you to find out that you sold the stocks too early and the stocks are still growing? And then there's this stock which you've bought them for a long time ago and you've actually lost like 50% of the investment, but you're still holding on to those stocks, like those SAPs and Zelegabili shares. Well, if your answer is yes, well, this is a very common behavior to each and every investor, and this is called the disposition effect. So one of the main causes of this effect takes us back to point number 4, where you're actively checking your investment portfolio and not letting your investment strategy take its full effect. And also another cause may be that you don't have an investment plan and you don't know what you're doing. So a good way to actually overcome this disposition effect is to use what we call the pre-commitment technique, where you put all your stocks, where you put all your winning stock and your losing stock within a time frame. So for example, when you come across hot assets, or maybe you come across like winning stocks, maybe like Tungla Resources for Limited, you're going to actually do a predetermination rather of when you're going to sell the stocks and when you're going to actually buy the stocks. So for example, let's say maybe you're going to, maybe you have like stocks for Tungla, right? And maybe you are going to decide, okay, I'm going to sell the stocks after maybe they're paying out dividends, or maybe after they reach the favorite mark. And that also implies for losing stocks. So for example, you actually have to have like maybe how much money actually tolerating to risk, maybe the risk tolerance of how long you actually want to lose the stocks. So for example, let's say maybe you're holding on to SAPs and Zelegabili stocks, and then maybe decide that, okay, I'm going to sell the stocks after maybe I lose maybe 20% of the stocks and then I'm done. So that's how you actually avoid this disposition effect, that okay, you're going to set a time frame of when you're going to buy the stocks and where you're going to sell the stocks, and maybe how much money you're actually willing to lose to actually maybe want to start selling those stocks. So that's a very good way to actually look into it, and that's one way to actually avoid this effect. So the bonus tip is lack of diversification. So one of the reasons why I want to talk about diversification is because a lot of investors actually either they short diversify their investment portfolio and they too diversify their investment portfolio, and other people don't actually diversify their investment portfolio at all. So one of the reasons why people don't actually diversify their investment portfolio is because they feel like there's only this one particularly company which they've invested in and they feel like it's actually going to make them rich, and all these other stocks don't actually matter to them. And the second reason why also people don't diversify their investment portfolio is because they're lazy and don't actually want to do a lot of research. So guys, please be sure to actually diversify your investment portfolio, because one of the reasons why diversification was actually developed is because you wanted to minimize the risk of putting all your eggs in one basket. Because if you put all your eggs in one basket, it's actually going to make you lose a lot of money which you're actually not willing to lose. So guys, I'm actually going to get more into diversification here in this video, and if you want to know more about diversification, how diversification works, how you can actually diversify investment portfolio, and how you can actually make money through diversification, then I highly suggest you to watch this video right here after watching this one.